One thing you mentioned was political shift, potentially. Now, that could be a threat or an opportunity. What happens if we shift governments in the US?
A return of a Republican government, and let's be specific, if it's a second term President Trump, a lot of the tax cuts that were put forward by President Trump during his tenure, the Biden administration are working hard to try and repeal. And if President Trump is returned to office, then I'd say that those tax cuts are likely to come through.
Which is great for earnings, right?
It's great for earnings, it's great for business, and we're likely to see that as an opportunity, that shift in government. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at a SWOT analysis of the US stock market and economy. Strengths, weaknesses, opportunities and threats. Plenty of notes to take out of here, but please do, as always, make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Olarenshaw.
Unlike us today, AB, we're going to have a pretty balanced podcast today because we're going to be talking about the US economy / stock market SWOT. Now, for anyone who doesn't know what a SWOT analysis is, strengths, weaknesses, opportunities, threats, the whole 9 yards.
Very scientific approach. Your segues are getting no better. That's going to be one of your weaknesses. I think that's definitely there.
Yeah, I think it's
opportunity to get better.
Yeah, I'm happy for people to laugh at me if it makes them feel better about themselves.
Well, yeah, SWOT analysis. So that's it's a management consulting technique actually to evaluate a set of circumstances, and I think it's actually quite interesting as we've sort of kicked this one around as to where the US economy is at right now, where the US market's at, and it's actually looking all right.
Indeed it is.
So, I mean, the main thing I would say from a strengths perspective is just that overall strength of the US economy. I mean, it's just been so strong. And if you look at the employment data, you've got a very tight labour market. Consumer spending has been relatively strong.
Record Black Friday last year too, through the nose.
Yeah. And those sorts of data points, and the reason I guess we talk about the consumer so much is that, and give or take a bit on this number, but ballpark consumer activity is around 60-65% of the US economic activity. So it's such a pivotal thing to be looking at. So that strength of the economy across the board and that consumer activity is really significant.
So to expand on the consumer for a moment's time, now when we initially had the inflation spike in the US and then interest rates started going up, which at the moment is still relatively high, we were talking about soft landing versus hard landing. So whether we're going to have a recession or not.
No landing.
No landing, because the consumer has remained so strong, their spending and unemployment so low. You can't have a recession without high unemployment, right?
That typically is what you would expect to see. There's a risk of stagflation, which is a slight sort of deviation on all of that. But you're quite right. I mean, is it going to be a hard landing as they ratchet up interest rates? And again, this comes back to, I think, Jerome Powell's done an absolutely amazing job of threading the needle over there. And again, we've talked this previously. As a central banker, you're looking at data that's 2-3 months out of date. You're making a decision today, and you don't see any impact of that decision for probably 6 to 8 weeks on the other side.
Tough job.
So it's an incredibly tricky job, and they've done a really, really solid effort. And their ability to communicate with markets has also been good. I think to an extent, the reason the US consumer has been as resilient too is that the mortgage market there, as we know, after the GFC, a lot of Americans, when they do finance on a property, it's a 30-year fixed rate, which at previous low levels means that whilst interest rates have been moving higher, it's not really impacted on your ability to spend. So big lesson there, and I wonder if we're here in Australia going to learn the same thing this time around and maybe get a little bit better at having that fixed rate market there.
It's a good strength, isn't it? Learn from your mistakes and be totally transparent. That's perfect on the central bank's behalf in the US.
And I guess that strong consumer has started to spill over into earnings too. So we've had an earnings season which has looked to an extent a little bit mixed. But I think the beat was about 78%.
Yeah, I believe at this point in time of this podcast, to unfortunately to date it, there's about 77% of companies which have come in above their earnings per share expectations. Now the long-term average is about 67 to 70%, so it is above the odds.
Yeah, so stronger than average earnings growth and annual earnings growth sitting where you're across the number 6-7%?
They're expecting about 9% year on year at this rate. So it is going to be much higher than what they thought. This season was supposed to be fairly lackluster, but as it turns out, some big names in there like Google and Microsoft have really helped come above the odds.
That is a really firm number, and I think when you look at pullbacks in the market, it's when that's what's sitting behind the scenes in terms of the overall strength, it becomes a buying opportunity, not your first opportunity to start reducing your position. And as we've seen the market recover from the recent sell-off over the last few weeks, it just shows that. And I guess the term there would be resilience.
Indeed.
And it's been incredibly resilient to a lot of external shocks. There's a lot of trauma going on in the Middle East right now, and yet the market shrugged that off reasonably well in terms of any negative impact, at least at this point in time.
Now, to change gears here, AB, because you can't have strengths, unfortunately, without having any weaknesses, if we can. So weakness is probably one that we can talk about, that we have spoken about a lot of times, that's both an opportunity and a threat, an opportunity and a weakness, is a heavily reliance on AI for a start, and also narrow breadth in the market.
Narrow breadth is always a concern. So when you see an index on a stock market that's been making new highs, you think, the stock market's really healthy. But when it's driven by a relatively small number of gigacaps, a Magnificent Seven, which have been really solid outperformers, what that tells you is there's actually, as you start to move away from the real big caps, that there's not a lot of activity on a positive side there, and that narrowness is also a vulnerability. So it's definitely a weakness for the market that it hasn't been as broad-based a run through. But nonetheless, if you're trading the index, it's been fantastic,
magnificent.
And that's a great reason for really looking at an index, because it removes any of the stock selection risk, and you're just taking the big chunk out of the driver there.
To talk more about the index right now, so if we look at a weakness in the market, currently by traditional standard, when we look at the forward price to earnings 12-month ratio, it's at about 21, 22 times its earnings, looking at the S&P.
Expensive.
Historical is about 16 times. So I guess by to that traditional method, the market is technically overvalued at the moment.
Yeah, I mean, to try and explain, when we look at a valuation, what you're looking at is the earnings that the company is generating divided by its price, and that gives you an idea of how many earnings cycles you need to hold the stock for to effectively have it as self-funded. So, as you say, historically, 16, 17 times is the average. And at 22 times, that means basically what you're paying for your shares today, you've got to hold for 22 earnings cycles before the earnings themselves have covered the cost of the share, if you look at the math on it. So what that tells you is the price of the shares are pretty high, or that the earnings are quite weak. But we've already discussed the fact that the earnings have been above average too. So the earnings are actually very strong. So you've got high earnings, and you've also got this extended multiple, which does show that the market is massively overvalued. But just because a market is overvalued doesn't mean to say it's going to implode. If you continue to see that earnings growth driving it through, with things like, as you mentioned, AI and such like, it can be, for a period of time, sustained at those levels. But it is, on a pure valuation basis, that's starting to get pretty toppy and pretty expensive. But if it keeps going up, well, it's good value.
Indeed. It makes it a little tougher too, because some of these gigacap stocks, as you mentioned earlier, aren't necessarily valued on traditional methods like PE, because if they're really priced at what they're going to do down the track, not right now.
There's an enormous expectation of what's coming in down the line, and the challenge with that is that if the bell doesn't eventually ring at some point, the sell-off in those kinds of stocks is really horrific. So, like any investment, you buy something today not for what it's done in the past, but you're buying it for what it's got the capacity to do in the future. And when you've got companies in the tech space, for example, that are, and there's huge, we just talked about a fairly tight labour market, but there's huge layoffs that have been happening, for example, in the IT and tech sector, where AI is already starting to replace people to a reasonable extent. And the expectation that reduction in cost and increase in efficiency is going to result in more profit. If that pans out, these companies are great value and they're cheap right now, even though they look expensive by historical measures. But if they don't deliver, if the earnings growth doesn't come down the line, then the sell-off will be savage.
Indeed,
savage.
It makes it tough, doesn't it, to judge? Now, another weakness in the market currently is higher inflation. Now, inflation has been on a downwards trend, we know that, but recent data points, early 2024, slightly higher than what economists had anticipated, so a little stickier than what we thought.
Inflation takes a long time to root out of your economy, and I use the analogy, it's kind of like a limpet on a rock at the beach. It's not something you can pick off. You've got to really chip away at it, and it's very tenacious. getting that last little bit out, and the data points have been a little firmer, I think, than what the Fed or anyone was really expecting. And I guess the risk of inflation is that there is a possibility of that there could be further interest rate rises in the pipeline. So another increase to try and combat that. Probably not going to happen, but it is something that kind of sits there, and so inflation is something to be concerned with. Why? Well, it can really impact on the consumer and consumer spending, and we've talked already that that's actually been pretty strong, and that it's helped buoy earnings for companies. So if it slows down because of inflation, more expensive to buy stuff, you'd expect to see an earnings slow down, and then all of a sudden those shares that are trading at multiples of historically high multiples look very, very overvalued.
Indeed.
So that most definitely is a weakness within there, is the unknown quantum of inflation.
All right, well, now my favourite component out of all of this, and that's the opportunities. So SWO, opportunities. Right now in the market, so much momentum, positive sentiment, things are going up.
When something's in a trend, that as the old analogy used to be, the trend's your friend until the end. And if something's trending, it's very likely to continue to do so. Why? Because there's a weight of money that comes in. If you look at psychology within markets too, you've got that, I guess, fear of missing out. So you might have been sat back on this more recent pullback that we've had and gone, okay, it's happening, the sell-off's happening, bear market time. I need to see it recover and go again. And then you go, well, if I'm not in now, it's going to be too late. So that buying momentum, that later buying momentum can really kick in and give things a move along. And it's supported by earnings growth. It's not just a speculative buy. Earnings are growing. So, momentum is massively important. And it's likely to continue, at least for the foreseeable, whatever, of course, the foreseeable is.
Indeed. Well, use it to your advantage. Mm-hmm. We certainly have been taking some fairly speculative positions in certain areas of our business on the indices, and it's worked out very well for us.
Very much so. And I think another big opportunity in there is in the bond play.
Indeed.
I'm positioned myself. I've got a lot of my close clients are doing the same thing, where our view is that interest rates have peaked. We're at the top of the cycle. We may not be seeing the cuts as quickly as we wanted to because of the threat of inflation, and the Fed has been very, very careful not to. Central banks don't just go, okay, we're raising rates this month, cutting them next month. It doesn't work like that. It's a much longer term approach. But nonetheless, I think we're toward, if not at the top of that interest rate cycle now. And the next stage is for some static level for interest rates, and then moving into cuts. And some of the investment banks out there in the US particularly, they're still calling for a cut this year, and I think there's enormous political pressure that'll be on the Fed and Jerome Powell to give us an interest rate cut prior to the November election, because it'll sort of look like the Bidenomics is working. It might look like it, but it's not. And on the back of that, positioning yourself where your long bonds or short bond yields is likely to be quite a profitable area. So there's a huge opportunity on that. And if we see 4 or 5 cuts next year, that long bond play will be off to the races.
Indeed.
It's a big opportunity there, yeah.
One thing you mentioned was political shift, potentially. That could be a threat or an opportunity. What happens if we shift governments in the US?
Look, a return of a Republican government, and let's be specific, if it's a second-term President Trump, a lot of the tax cuts that were put forward by President Trump during his tenure, the Biden administration are working hard to try and repeal. And if President Trump is returned to office, then I'd say that those tax cuts are likely to come through. Which
is great for earnings, right?
It's great for earnings, it's great for business, and we're likely to see that as an opportunity, that shift in government. I think also from an opportunity perspective on the subject of politics, I think a return of a Trump administration is very likely to see trade tariffs come back into play again. And let's face it, they're probably required when it comes to dealing with China, which seems to have a very uneven stacked deck in its favour from a carbon emissions. I mean, you look at the carbon emissions that come out of China, it's like 60% of the world's carbon emissions.
Crazy.
Is insane, but it's okay because it's an emerging market. It's the world's second biggest economy. It's not an emerging market. It's emerged. And you've got to kind of get tough on this. And I think, a second-term Trump would be quite tough on that with China. And that's, I think, good for manufacturing jobs and American companies per se, because they've got a shield to operate behind. And I think we may well see that spill across. I think we've talked about that in previous podcasts to Europe as well, where the notion that the US has been propping up NATO at its own detriment, we might see a little bit of trade tariff there, as well as they use that as a stick to get the European countries to pay up their fair share. So, I think tariffs actually would be an opportunity for the US market, just a little bit of protectionism to operate behind. And I'm a big fan of free markets, but sometimes you have to do what you've got to do. If the playing field's not level, you've got to try and level it up in the way that you can.
Indeed. Now, what about a stock market specific one, AB? So we talk about late cycle plays during these times, so energy and commodities. Yeah,
energy and commodities would be your typical sorts of plays late cycle. Energy started to get off to quite a tear and came off fairly heavily without obviously wishing to date this too much. That Middle East unrest is typically quite good for energy prices. The US is in a pretty tricky position energy-wise. Obviously, part of the Inflation Reduction Act and some of the work undertaken by the Biden administration was to release a large quantity of its strategic petroleum reserve, with the notion of we'll buy it back when it's cheaper, but prices have continued to go up. So that's kind of imploded a little bit, and they've now said, well, look, we're not buying back. But that would be a good backstop behind energy prices too, as they have to sort of refill the tens of millions of barrels of oil that they've let go.
Indeed. What about one that's probably an opportunity as well as a threat, depending on which side of the ledger you want to play on? That's volatility, because there's great money to be made, but also can cause a lot of uncertainty. Yeah,
look, volatility, the crazy trade, if you wanted to call it that, is always there. And there are always events that potentially can happen that cause a significant and very, very fast increase in volatility. The fact of the matter is volatility is very, very low right now, so it's cheap to buy. You can buy volatility in the hope that it goes up just like a stock. And we've seen, based on how resilient this market is and how trending it is, that's why volatility has been going down. It's a resilient market that's got momentum, it's in a strong uptrend, so vol typically goes down. If we were to see a pullback on equities, the opportunity of that pullback on equities is to buy and go long volatility and profit from that, which is a good play. Makes things a little tougher in the options market, which is of course our backyard, because if you're a seller of options, cash on demand type stuff, when volatility gets a little bit lower, the income potential is a bit softer. You maybe have to go out a little bit longer with some of your trades in order to garner the income that you want to do, but certainly a play there for buying volatility long term at these levels.
Or a hedge play as well in your portfolio too, if you want to mitigate that risk as touch.
Absolutely, couldn't agree with you more there. I think that's a great way to do one transaction that kind of gives you a partial protection on your portfolio for sure.
Gotcha. Now some threats, AB, before we finish up. Now these aren't necessarily weaknesses in the economy or the market as of yet. One that probably stands out to me to kick off would be just a little bit of a softer reading the last couple of months in consumer sentiment.
Look, a weaker consumer, as we've spoken of, is not great news. And at the end of the day, when you're dealing with higher energy prices, higher food prices, higher rent, or higher loan repayments for those people that have purchased homes at higher rates, that money has to come from somewhere. And the US consumer has had to pony up a little bit more. So, there is the potential to see some softening there on the back of a lower disposable income. And that's one I think is a threat which is really significant given the scale of consumer activity within the US. And everything is just insanely expensive. I was having a yak with a buddy at the airport. Apologies for being in flying gear today.
Try your look handsome, look good.
I just bumped into a buddy of mine at the airport in Sydney this morning, and we were talking about a couple of places we used to hang out in the US. We used to do a Playboy Mansion every month, for example, and a couple of restaurants we went to, and we're just looking to see the prices now.
Nuts.
Yeah, it's just insane, and that is something that at some point in time has to be paid, and the consumer spending slowing down is definitely the jar that money would be coming from.
Doesn't help too that we may have potentially as a threat higher rates for longer as well. With that stickier inflation, as we mentioned, as a weakness, that's then led the market to believe that rates will be higher for longer, and that we may or may not get a cut this year. I mean, initially we were expecting a cut to be in March. That's all the way been pushed back to September now.
Indeed. People were sort of banking on, okay, the rate cut's coming, so we're okay. This is temporary pain. And now that pain's going to be lasting a little longer. And you can't ride that out. And I always talk about the three levels of struggling consumers. Firstly, it's denial. oh, this will change, it's only short term. Well, it's not been short term, it's been a few years. The second phase is the damage phase, whereby you genuinely have to start crimping your spending in order to tighten the belt. And then the third phase on there, which is the desperate phase, where you do anything to get yourself back on track. And I think for a lot of people, they're well into the damage phase right now, and it's hard to see that. And it's definitely a risk. And if we have interest rates that are kept higher for longer, as you say, no rate cut maybe till later this year, a lot of people were probably banking on it coming sooner than that, and as a consequence, it's stripped out a reasonable chunk of what they've got to spend. So consumers been resilient, but can be disrupted very, very quickly because it's a knee-jerk emotional reaction. If you think about if your mortgage jacked up by $300 for the month, the money has to come from somewhere. And that $300 could be a big chunk or a portion of at least your discretionary spend. You stop spending it because it's got to go to the mortgage.
That's right. It makes it tough, right? And then you see economic activity slow down as well, which we haven't seen at the moment, but we could see.
Yep.
So to move forwards, as a couple of more threats, AB, talk about geopolitical tensions as well as political tensions at the moment too. How do those two play into markets?
Look, I think geopolitics, with two wars, significant wars going on in the world at the moment, and it's very much a sort of East versus West type situation, both with obviously the war in the Ukraine and also what's been going on in the Middle East there too. And they run the risk of escalating. We saw Iran sort of semi-get involved a few weeks ago, and that went away just as quickly as it started. But the risk that presents to markets of a wider escalation, a contagion of that war across the region is huge. And that's not something I think you can ignore. And I go back to my point on volatility. With the risk that comes alongside the prospect for a more, I hate to use the term, but more gnarly war than what's there already. All war is gnarly, but particularly if it escalates or spreads, that then would be a kicker for volatility. So that is very much a real threat. We've also, politically, we'll talk about the US in a moment, but I think it's something like 45% of the world's population is going to an election this year. India, South Africa, the UK, the US, amongst others. And there are some crazy things that can happen during elections, and that uncertainty that comes from political change, particularly if it's not the ideal political change from an economics point of view, certainly runs the risk of being a threat for markets. Turning to the US, where do you start on it? I mean, it's a spectacle which politics should be boring. That's how it's supposed to be, but it really...
Not over there. It's a comedy show.
It's if they're the best two that you can offer up in a country of, what was 400 million, but now you've got 15 million illegal immigrants, so there's a few more people there. If that's the best you can offer up, it's a pretty sad show. I think on balance, a return of a Trump administration is better for the US economy. And I don't say that based on a political persuasion. I'm not a US citizen. I don't vote with what's going on over there. I'm totally agnostic as to that. Looking at it just purely and simply through economics lenses, I think a Trump administration is far better for the US economy, and it's certainly far better for the US stock market. We've talked about tax cuts and tariffs, for example, that would likely come on the back of a Trump win. On the other side of the coin, Bidenomics has been an epic fail on so many metrics, and I think the threat that so many lower income earners in America particularly are beginning to realize is the influx of immigrants, and particularly illegal immigrants, will drive hourly rates down in low paying jobs. So if you're a busboy or a dishwasher in a diner, for example, or you've got like a really low income type job, and someone that's just come across the border is prepared to do that for $2 an hour less than you, that constraint, I think, on particularly that lower income group is going to be really, really marked. And I suspect post November 6th and the election, that's going to be where a lot of the swing voters abandon the Democrats in favor of a Republican government, purely and simply because they will be worse off and are now worse off under the current administration, which is... it is what it is, and people that are worse off spend less. Consumer spending, as we've discussed, is a major thing. But I think from a threat perspective that's a little bit more sinister, looking at the political landscape there, and it's not just in America, it seems to be more of a global phenomenon now, it's become incredibly tribal. There's no middle of the road where okay, that's a fair point. I don't really agree with a lot you've got to say, but you kind of, that makes sense to me. There's none of that now. You're either there or here, and that's it. And I think the scope, very sadly, for some election interference, and I don't mean in through the lens of a sort of, oh, we had the election stolen, but maybe perhaps for an assassination attempt, is a very real possibility in the run-up to this, which would be a woeful indictment as to democracy in that country. But also, I think, irrespective of who wins in November, I think there's a very, very high probability of some major civil unrest, and depending on how that's dealt with and which side actually wins and how they choose to deal with it, has got the potential to really derail a lot of confidence and momentum, both in the US economy and then on the back of that, of course, the US stock market. So that political threat, I think, is going to become, at the moment, is kind of grey, font 2, fuzzy and in the background. But as we get closer to election day, it's font 50, bold, bright coloured and right in your face. And it's going to become a bigger and bigger aspect to the overall look for the US economy and market, I suspect.
A lot to juggle there. Be aware of the weaknesses and the threats, but take advantages of the strengths at the moment, also the opportunities.
You make hay while the sun shines, and I'm often reminded, you can have all the ifs and ands in the world, but if ifs and ands were pots and pans, there'd be no need for tinkers.
Love that. Very nice, AB. Great way to finish.
Great East End expression, that one. You can bank that one. You can use it if you like. Thanks very much.
Cheers.
There you have it, guys. Make sure you give us a review and a rating, and we look forward to hosting you next week.